Welcome to this practical session on IAS 2 Inventories. In this lesson, we are going to solve practical questions step by step so that you clearly understand how the principles of IAS 2 are applied in examinations and real-world scenarios. This session will help you move from simply knowing the standard to actually applying the standard. In today's lesson, we will work through questions covering application of the first in, first out cost formula, inventory valuation using the weighted average cost formula, and applying the lower of cost and net realizable value rule. Question 1. Majesty Limited is an international trading company. The business started operations on January 1st, 2020. Majesty Limited imports goods and sells them in the local market. It uses the first in, first out method to value its inventory. Listed here are the company's purchases and sales during 2020. Purchases: February, 20,000 units at 25 Ghana cedis each. March, 25,000 units at 30 Ghana cedis each. August, 30,000 units at 35 Ghana cedis each. Sales: June, 25,000 units. November, 30,000 units. The company prepares reports quarterly based on the purchases and sales information of Majesty Limited. Show how inventory will be valued at the end of each quarter. With this question, we are going to learn how to calculate the cost of sales using first in, first out method, and also determine the closing inventory at the end of each quarter. We've already been told that the business uses the first in, first out method. How does the first in, first out method work? This method assumes that the inventory you bought first is what you sell first. So first in, first out. What comes in first goes out first. So how do we go about this question? I am going to solve the question in Excel. So I've already pre-filled some formulas to make it easy and fast for us. So we set it out in this way. You have your date, and then the details, the quantity, the cost, and then the amount. Our first purchase transaction was in February, where 20,000 units at 25 Ghana cedis each were bought. And then in March, 25,000 units at 30 Ghana cedis each. We begin with these purchase transactions. February 2020, we made a purchase of 20,000 units at 25 Ghana cedis each. It's a purchase transaction, 20,000 units at 25 Ghana cedis each, giving us 500,000 Ghana cedis. And then in March, another purchase transaction of 25,000 units at 30 cedis each. Both purchase transactions amounted to 1,250,000 Ghana cedis. So these are the only purchase transactions in the first quarter. Our next transaction is a sales transaction in June, which happened in the second quarter. So we need to value our inventory at the end of the first quarter, just as the question requested. The first quarter ends on March 31st, 2020. We have inventory valuation. Because this is the first in, first out method, we need to list the available inventory at their respective prices at the valuation date. So we have 20,000 units at 25, and then 25,000 units at 30. This is how our valuation will be done at the end of the first quarter. We'll set them out this way so that when there's a sales transaction, we will know what to sell first. So if there's a sales transaction, we are first going to sell all of this before we sell what we bought at 30 Ghana cedis each. Now we move on to the next quarter, which is June 2020. And in June, we had a sales transaction of 25,000 units. Mind you, we weren't given the cost at which the sales were made. That cost will be determined from the cost we already have listed. The sales transaction of 25,000 units will mean that we are first going to sell 20,000 units out of this until it is all exhausted, and then we move on to the 25,000 units. Now let's have it set out. June 2020, it is a sales transaction, 25,000 units. First, we sell all of the 20,000 units at 25. Giving us 500,000. And then we sell 5,000 units out of this 25,000 units at 30. Let me make this clear. The 25 Ghana cedis we have here and the 30 Ghana cedis we have here is not the sales price, but rather the cost of sales. So for this sales transaction, we are going to have a total cost of sales of 650,000 in our profit or loss account. So this is how the sales transaction will be set out. At the end of the second quarter, after the sales transaction, what is the value of our closing inventory? June 30th, 2020. Inventory valuation. We've sold all of the 20,000 units, and out of the 25,000, we've only sold 5. Our remaining units are 20,000 units at 30, and that is giving us 600,000. So at the end of the second quarter, in our second quarter report, we will show 600,000 as inventory in our balance sheet. We move on to the third quarter. In the third quarter, there was a purchase transaction of 30,000 units at 35 Ghana cedis each in August. August 2020, we had a purchase transaction of 30,000 units at 35 Ghana cedis each, giving us 1,050,000 Ghana cedis. There wasn't any sales transaction in the third quarter. Third quarter ends on 30th September 2020, so we need to do evaluation September 30th, 2020. Inventory valuation. We had 20,000 at 30. We show that first, 20,000 at 30, giving us 600,000. And what we bought in August, 30,000 units at 35. So at the end of the third quarter, we had a total inventory valued at 1,650,000. We continue with what happened in the third quarter. There wasn't any purchase transaction in the third quarter, but a sales transaction in November. We sold 30,000 units. November 2020, a sales transaction of 30,000 units. Our closing inventory shows 20,000 at 30. We sell that out first. 20,000 units at 30. And then 10,000 units at 35. Giving us a total cost of sales of 950,000. There wasn't any other transaction in the fourth quarter, so we do evaluation at the end of the fourth quarter on December 31st, 2020. Inventory valuation. Out of the 30,000 units at 35, we only sold 10,000 units. Now we have a remainder of 20,000 units at 35, giving us 700,000 Ghana cedis. This will be the value of inventory on the balance sheet at the end of the year. And this is how first in, first out valuation is done. We continue with the second question, where we will learn how to apply the weighted average cost formula. Question 2. Majesty Limited uses software to cost and value its inventory. This software values inventory using the weighted average cost method only. The following are the purchases and sales information for 2022. January 15th, 200 units at 200 Ghana cedis per unit. March 15th, 200 units at 300 Ghana cedis per unit. September 25th, 200 units at 350 Ghana cedis per unit. Sales. March 25th, 100 units. December 15th, 175 units. Based on this information, prepare the valuation of the inventory and the cost per unit of the inventory at the end of each quarter. With the weighted average cost method, we only have to calculate a single average cost for all items and apply that average cost to each one you sell. Now to our solution. It is set out in a similar manner to the first in, first out. You have our date, details, the quantity, the cost per unit, amount, and then our weighted average cost, which we will calculate after each purchase. We are to present our answers in quarters, so we begin with the first quarter. In quarter 1, we had 2 purchase transactions and 1 sale transaction, January 15th and March 15th, and then March 25th. We begin with our purchase transactions. January 15th, 2022, a purchase transaction of 200 units at 200 Ghana cedis per unit, giving us 40,000 Ghana cedis. And then on March 15th, 2022, another purchase transaction of 200 units at 300 Ghana cedis per unit. So after these purchases, we have 400 units at a value of 100,000. Now we need to calculate our weighted average cost. We do this by dividing the total value by the quantity. This average cost will be our cost of sales per unit of items sold. The next transaction in the first quarter is a sales transaction of 100 units on March 25th. March 25th, 2022, sales. The quantity is 100 at our weighted average cost, 250, giving us a total cost of sales of 25,000. These are the only transactions that took place in the first quarter. So we need to do an inventory valuation at the end of the first quarter on 31st March 2022. Inventory valuation. We had 400 units and we sold 100. We are left with 300 units. The total value of our available inventory was 100,000. out of which we've sold 75,000. We have left 75,000 Ghana cedis. Finding an average will give us 250 Ghana cedis per unit. We had no transaction in the second quarter, so that will mean that at the end of the second quarter, the value of inventory we will have to show on our balance sheet will still be 75,000. Quarter 3, we have a purchase transaction of 200 units at 350 Ghana cedis per unit on September 25th. Purchase transaction of 200 units at 350 Ghana cedis per unit, giving us 70,000 Ghana cedis. There was no other transaction in quarter 3. We will do an inventory valuation at the end of the third quarter on September 30th, 2022. From the last inventory valuation on 31st March, we had available 300 units, and we've added 200 units to that on September 25th, giving us an inventory quantity of 500. From the last valuation, our inventory was valued at 75,000, and we've added 70,000. The sum will give us 145,000 Ghana cedis. We need to find an average cost or a weighted average cost. 145,000 divided by the quantity 500 will give us a weighted average cost of 290. This will be our new weighted average cost per unit. We are now in the last quarter of 2022. The only transaction that took place in the fourth quarter is a sales transaction of 175 units on December 15th. December 15th. A sales transaction of 175 units. This will be issued or sold at our new weighted average cost of sale per unit, which is 290 Ghana cedis, giving us a total cost of sales of 50,750 Ghana cedis. We've taken care of all the transactions that occurred within the year. We are at the year end on 31st December 2022, and we need to do an inventory valuation. December 31st, 2022. Inventory valuation. From the last inventory on September 30th, we had 500 units, out of which we sold 175 units. We have 325 total inventory available, amounting to 145,000, out of which we've sold 570, giving us a difference of 94,250 to show on the balance sheet, and the weighted average cost per unit is 290 Ghana cedis. This is all for question 2. We move on to question 3, where we will learn to apply the lower of cost and net realizable value rule. Question 3. The following are the quantities, cost, estimated sales value, and the cost to complete for the items of inventory held by Majesty Limited at 31st December 2025. We have our items A to E, the quantities in units, and then the cost, estimated selling price, and cost to complete, all in Ghana cedis. We are required to calculate the net realizable value for each inventory item, and then the overall value of all the inventory items. The first part of the question requires that we calculate the net realizable value for each inventory item. Let's remind ourselves what the net realizable value is. The NRV refers to the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated costs that are necessary to achieve the sale. With our question, the NRV is calculated by simply taking the estimated selling price for each item and deducting the cost to complete. Let's do that. The estimated selling prices for items A to E are 2.5, 4, 10, 6, and 1.2 Ghana cedis respectively. Let's list them. 2.50, 4, 10, 6, and 1.2. The cost to complete for each inventory item is 0.5, 0.8, 1, 2, and 0.25 respectively. 0.5, 0.8, 1, 2, and 0.25. The NRV is calculated by deducting the cost to complete from each item's estimated selling price. Item A, we had 2.5. We had 2. Item B, 3.2. Item C, 9. Item D, 4. And item E, 0.95. The next part of our question requires that we calculate the overall value of the inventory items. And this is where we apply the cost and NRV rule. The principle says that inventory shall be valued at the lower of cost and net realizable value. All this means is that we will list the cost of each inventory here and also list the net realizable value we've calculated in the first part of the question. So let's have that. Simply copy this and paste as values. Let's have the cost of each item and their respective quantities. 500,000, 750, 750, 2005 respectively for items A to E. 500,000, 750, 750, and 2,500. Now we need the cost of each of these items. 2, 4, 6, 5, 1, 2, 4, 6, 5, 1. To get the value of each inventory, we apply the principle, the lower of cost and NRV. For item A, both cost and NRV are the same, so we can choose either of them. Item B, cost is 4, the net realizable value is 3.2. The lower of this is 3.2. So to get our value, we multiply the quantity 1000 by the net realizable value, which is 3.2, giving us 3,200. Item C, cost is 6, net realizable value is 9. The lower is 6. We use that to compute our value, which is 6 by 750. Item D, cost is 5, NRV is 4. The lower is 4. We use that to calculate our value. And item E, cost is 1, NRV is 0.95. The lower is 0.95. And we use that to calculate the value of our inventory. So that is how we arrived at the value of each of the inventory items, giving us a total inventory value of 14,075. This is everything for question 3. We've learned how to calculate the NRV and how we apply the cost and NRV rule. Thank you for watching. See you in our next lesson.